Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? My episode today is with one of the more thoughtful, open-minded, and I would venture to say broad thinkers in the Bitcoin space that I've come across. His name is Nic Carter, and he's the co-founder of both Castle Island Ventures, which is a crypto-focused VC fund, and coinmetrics.io, which is a platform devoted to demystifying on-chain data, which we actually spend some time doing in this episode, specifically around trying to put a value on the Bitcoin network and also on its advantages and limitations as a protocol for transferring value across the internet. Nick also has a master's in philosophy, and we spent a lot of time in the overtime to this week's episode applying that discipline to Bitcoin by examining the works of people like Friedrich Nietzsche and his philosophy around essence, John Rawls and his veil of ignorance, as well as applying a strain of utilitarian thought to questions of money and society. I think it's important for all of you to understand where I think this episode fits in the library of content that we've put out on cryptocurrencies and distributed ledgers. I think most, if not all, of my coverage on crypto DLT has focused primarily on the problem of scalability, technical implementations for various base layer protocols, and financial arguments, whether we're talking about arguments that weigh the merits of speculation in something like Bitcoin, or even pseudo-political arguments, stuff like re-engineering the gold standard and displacing the fiat-based global financial system with sound money. This conversation explores all of those themes, but with, I think, an intention on my part to understand Bitcoin as more than just the sum of its parts, and as more than just a permissionless ledger for tracking debits and credits. One of the lessons I've taken away from my continued education into Bitcoin through the works of people like Nick Szabo, Paul Sztorc, and others is that trying to measure Bitcoin against existing systems or conventions that seem somehow comparable is almost always counterproductive. And I think that's because it represents so much more than just money or a payments network or a Wall Street speculation. There's a competent and I think genuine community of intellectuals within Bitcoin who are actively engaged in what feels like a grand project to remake society. And it comes across in the seriousness with which they apply themselves. Whether we're talking about the engineers working on enhancements to the base layer and scaling solutions, or whether we're talking about folks like Nick and others who are contributing intellectually to debates about governance, economics, and ethics. In other words, Bitcoin is not what most of us think it is. And even what we think it is constantly changing. And I think that its endurance, its evolution, its resilience as both a store of value but also as a diverse community of people who are coming to it from different backgrounds and with different motivations. All of this suggests to me that there is much more going on here than just a naive speculation. As Nick points out during our conversation, Bitcoin is a subversive idea. It's an experiment in social organization that doesn't play by the rules of the state or by the conventions of modern society. And I think the momentum behind it is only going to grow, especially if governments validate the concerns of its proponents with further debt monetization or preferential bailouts in the event of another global financial downturn. Now, before I hand it off, I want to thank those of you who heeded my call to action last week and rated the podcast. We added close to 100 reviews since last Monday. We crushed it. You guys are awesome. And I'm here to thank you with an even more awesome episode with my guest, Nic Carter. Nic Carter, welcome to Hidden Forces.
Pleasure to be here, man.
So there's so much stuff to talk about, Nic. It's actually kind of challenging to know where to start. I've read a lot of your material, and that's sort of why it's challenging. You write really well, thoughtfully. You're a philosophy major. Give our listeners a bit of a background of who you are and sort of how you came into this space.
Well, that's like the classic question. It's like, when did you discover Bitcoin? When did you have the white paper? When did you read the white paper? Everybody has their own origin story. And everybody's told them so many times now that very few of them are actually grounded in truth, I would say. And so mine's not very interesting with regards to Bitcoin. I just I discovered it on Reddit or Slashdot early on, and I liked the fact that you could just tip people permissionlessly through the internet. I thought that was funny. And then I only got turned on to the ideological underpinnings much, much later, thanks to the Pierre Richards and Michael Goldsteins of the world. So I owe them a debt. So I came into Austrian economics and all of these Austrian theories through Bitcoin as opposed to the other way around, which I think is a little different. But I used to work as a journalist. I used to write about corporate law, which was very dull. And eventually I went to business school and I wanted to go work in investment banking. But around that time, this was about 2016, I realized that cryptocurrency and Bitcoin were these really vibrant industries. And so I decided to see if I could make a career in them. So I worked at Fidelity as their first crypto asset analyst in 2017. And then in 2018 left to start a public blockchain focused venture fund.
Well, we're going to talk about that too. What's the name of the fund?
Castle Island Ventures.
Castle Island Ventures. And you guys are based out of Boston.
Yeah.
So what attracts you to Bitcoin today? What is it that most endears you to this community, to this protocol?
I think Bitcoin's the most interesting phenomenon occurring on the planet right now. And it's so rich and there's so much depth to it. It sits at the intersection of so many different disciplines: computer science, cryptography, econ, political philosophy for sure, corporate governance. Like, they're all relevant. And there's so much you can get out of it. So I think it's a shame that people really write it off because they don't like a certain feature of the thing, like the energy usage, for instance. I've spent the last 5-6 years reading and thinking about Bitcoin almost constantly. And I call myself very lucky to be working within the industry and being able to support companies building on top of Bitcoin. So I'm in a rare case where my hobby and my professional life and my academic interests are totally aligned. So I consider myself extremely lucky to be able to say that.
So if someone comes up to you on the street or you're having dinner with a family friend and there's some stranger at the table and he says, "Nic, I don't know anything about Bitcoin. Can you tell me, what is Bitcoin?" What would your answer be to that question?
That happened to me on the train down here.
Did it really?
Yeah. But the thing is, actually, most people kind of know a thing or two about Bitcoin.
They do. Did you feel like it's a situation just like in economics where what they know has actually hurts their understanding?
Yeah, I wish that people came in tabula rasa, blank slate rather, because most people their opinion of Bitcoin is colored by what they see in the press. And so they typically don't like it because, in fairness, you see this thing that's this incredibly well-performing investment, probably the best performing investment of the last decade. Maybe there were some venture exits that were better, but I'd be hard-pressed to find them.
Starting at what price are you?
Well, you start at zero, so it's up an infinity percent. So people hate that, right? Because, for the most part, they didn't participate in it. And then you get all these headlines about how it's using, one Denmark's worth of energy. And so there's the environmental narrative layered on top of it. So then the default reaction there is to hate the damn thing. You're like, what is this? Could it be that the nerds on the internet created a new money and, we're not able to participate in this? And so I think people also get a bit nervous that maybe it's going to keep going and keep sort of being impactful and significant. And, then they maybe start to, wonder a little bit about, what money is even and who has the right to produce it and so on. But yeah, it's a very aggressive, disruptive thing. So I'm not surprised that most people really dislike it.
So your experience is that most people, the vast majority of people, have some idea of what it is, irrespective of whether or not that idea is correct. They've got some idea.
At least in the US.
That's
Yeah.
interesting. And that narrative is colored by its energy usage or the perception of it being wasteful, using up tremendous amounts of energy. You said that these nerds created this money and got rich. I actually think that the most forward-facing personalities in this space are not the nerds, but actually kind of the bros.
Well, they're the ones
The
that
crypto
are
bros.
the most visible externally now.
Right, and they're sort of despicable.
Well, we've entered this eternal September, so it's mainstream now. So it's lost a little bit of its niche charm, because a lot of Bitcoiners, probably myself included, would love to go back to the pre-2017 era where it was just our quiet little hobby. But it just continued to exert itself and grow. And so then you basically, all the normies came in and found it. So that's where we are now.
So you said, I think you mentioned it, or I don't remember how you brought it up, but there are all sorts of different aspects to Bitcoin, which is what's so interesting about it. There's an economic aspect, there's a technological aspect. We've definitely covered the technology, generally speaking, specifically and generally. We've looked at it as an asset class as well with folks like Bernisky or Ari Paul. We have done a bit sort of at the edges on governance, but one thing that we really haven't covered has been the narratives of Bitcoin, right? And I think that was, of all the work that you've done, and we're going to get into a bunch of stuff, but I think I want to start with the narratives. You wrote a paper, I believe it was called Visions of Bitcoin, is that correct?
Yeah.
And in that paper, you had all these different narratives and how Bitcoin has evolved over time. And I think this is valuable because it also, I think, biases the perceptions of people who last engaged with Bitcoin at a certain time when it was a certain thing, right? And when I had first learned about Bitcoin, I had learned about it as, if I remember it correctly, it was basically kind of cash for the internet and a peer-to-peer payments network. That was how I learned about what it was. You've actually broken down the evolution, beginning with eCash and then moving to P2P, censorship-resistant gold, private, anonymous, dark net currency, which I think kind of died with the end of Silk Road or a few years after that.
Yeah. It's not used as much for that now.
Yeah. And a bunch of other things. But I want to talk about this because this also really speaks to why I've gotten interested in Bitcoin in the last year when I had, for the most part, written it off. Because I was focused on its limitations technologically, and I was sort of looking at the despicable elements of its community, and I didn't actually realize or appreciate the depth of its bench, so to speak, the depth of its community, and the fact that there are folks like you, Pierre, Tour Demester, all sorts of people, Hasu, who are writing in this kind of this digital community, this like little circle, not Vienna circle, but but you guys are all sharing, writing, and thinking through all these problems, and it's really deep stuff. So walk me through a little bit about the evolution of Bitcoin over time and the way the narratives have changed.
Sure. So, the interesting thing here is that Bitcoin itself has pretty much not changed. I mean, at its core, it's a ledger, so a state of balances of who owns what, and then it's a set of rules for how you can change the ledger. So that has been consistent, from 2009 to present with some updates. But what has been changing rapidly around that has been how people perceive it, and by extension, what they use it for. And, so Bitcoin is like this blind, deaf, and dumb thing. It's not aware of the world outside of it. It doesn't even know what its own price is, right? It works just the same if it's worth $1 or $1 million. So, what I wanted to do was to chronicle how people were perceiving it and what they thought it was good for. And really that gets into what they thought it actually is. So initially it was an experiment, which is why I said proof of concept eCash. And for a long time it was an experiment. And to some degree, the cryptographers that work on it still see it as an alpha, pre-alpha software. And then people began to realize that they could do interesting things with Bitcoin that they couldn't do with other systems. So cheaply send money on the internet for P2P internet commerce. And then, more subversive, people realized they could buy drugs with it online. And that was a huge part of the early narrative. And then the big kind of turf war began between the people that understood it as peer-to-peer kind of petty cash protocol on the internet and the people that see it as this, monetary phenomenon, which is a gold-like thing, which, they want to challenge central banks.
So how early on did that thread emerge? Because it seemed to me in the limited amount of writing that I've read from the earliest days of what Satoshi wrote, there seemed to be some element of that. I mean, there are certainly references to the 2008 crisis, and I wonder also, perhaps answer this as part of your answer, could Bitcoin have succeeded? Could it have emerged were it not for the financial crisis in 2008?
I love that question. I was just thinking about it. Like if Bitcoin was created in the 90s when most of the technological tooling to create Bitcoin already existed, not all of it, most of it, would have taken off the way that it did in this time of relative peacetime, monetarily speaking. Yeah, I mean, so to answer your question, there's this big discipline which I call Satoshi exegesis, which is scrutinizing the text, the holy text now.
The canon.
Yeah, to determine what he meant, because he or she is not around to elucidate, or they. I like to think that Satoshi is a time-traveling AI. There's other plausible explanations. But so to some degree, it's a little futile to determine what his intention was in creating Bitcoin, because Satoshi actually makes various contradictory references. Should this thing be cash? Is he creating it because of the financial crisis, which he absolutely makes reference to? So, now that Satoshi's gone, the community, is making their imprint on it. And I would say his intentions don't really matter as much now. But to answer your question, many of the early Bitcoiners, Hal Finney in particular, who was the first one to ever make edits to the code, aside from Satoshi, saw it as this high-powered collateral upon which you could create maybe a fairer banking system, which is what I align with the most. I think that's the way that the protocol is the most impactful. I think that's commensurate with its limitations. And I think that's, in practice, what is being used for already. So I definitely put me in that camp, as opposed to we think the base layer should be used as a P2P payments layer, globally scalable.
Right. So let's dig a little deeper into that aspect. What about it would make it a more fair financial system?
Well, Elaine Wu, who's this amazing writer, has this great quote about it, which is that, I'm going to garble it, but risk, in the financial system is abstracted away. It's kind of imperceptible. It's hard to quantify. It's socialized. But with Bitcoin, the risk is right there. Bitcoin brags about the risk right there on the internet. So it's rather quantifiable to know what the odds are of having your transaction reversed in Bitcoin. The settlement is probabilistic, so to speak. Whereas in the traditional payment space and financial system, it's very hard to know exactly what you're dealing with. Even, there may be risks that are undetected, or, you may believe that you're protected based on some government assurances, but that can also be the cause of a great deal of sort of chaos and risk. So it's much more abstract and I would say obscure. But then to be more concrete about it, I think Bitcoin is cryptographically auditable. So by running a full node, you can get the whole history of all of the balances on the network, which means you can audit the entire global supply of the commodity, of the thing, which is really astounding. I mean, compare that to gold. If you want to determine whether some gold that someone has given you is legitimate and it's not counterfeit, you need to get it assayed. You need a XRF like spectrometer or something, or you need to establish a system like in London, the LBMA, they have this trusted supply chain where every link in the supply chain is authenticated. So it's very costly and difficult to sort of determine the validity of an inbound payment. And that's part of the reason gold was centralized and ended up in, banks and central banks. With Bitcoin, it's very cheap and efficient to, ascertain the validity of an inbound payment and of the entire supply. So now that you have those assurances, you can build interesting things. You can build banks, with Bitcoin in their vaults that are provably solvent, for instance, with really standard cryptographic, operations. Or you could have a fractional reserve bank, which provably only had 40% collateral in the vaults or whatever reserve ratio you wanted. So that is the really interesting thing to me. And the ability to give end users that kind of transparency information is something that I don't think really exists in the current financial system.
So a few questions. One, to stay on the point about narratives, how does that fit into a narrative about Bitcoin being the settlement layer for global payments. I mean, how does that relate to this idea of digital gold? But also, is that really true? Because if we were to actually build out a fully functioning financial system, there would be tons of intermediary transactions. And in order to scale Bitcoin, you'd need to rely on second layer solutions. So really, how true is that you would get, quote, finality or a higher level of certainty about a bank's financial standing? How true really is that?
Yeah, I guess it's a good point because you can never really assess what a bank's true liabilities are, even if they have some like highly auditable collateral in their vaults. But I think what you can do is just close those informational gaps that exist. And yes, like reintermediation in a cryptocurrency context is something that seems very paradoxical and gets us laughed at, I would say, by industry critics. It's like, oh, these guys thought they were decentralizing, and yet here they are building up. The running joke by Matt Levine, the Bloomberg columnist, is that everyone in cryptocurrency is just relearning all the lessons of finance in slow motion. They're just, or in accelerated motion.
Isn't that kind of true?
I would say yes, absolutely. But it's interesting that they're doing that.
Right.
It's like, yes, we're going through this accelerated process of condensing the last 5,000 years of financial history into 10 years. But the objectives are fairly noble, I would say.
Well, let's actually stay with that. If that's the case, because I have a sense of it, which is I think that the best arguments I've heard ultimately have to do with basically re-engineering the gold standard. It seems to me that what Bitcoin offers is, in the face of the scaling issues, the fact that you need second layer solutions, that what it offers is a base layer that provides uninflatable money, right? Private issued money, non-fiat money, and accountability in terms of credit creation for the banking system. That's what, for me, is a viable alternative that can be built using Bitcoin. But how would you frame it? How do you see it?
No, I think that you put it very well, actually. And many Bitcoiners are Austrian, so they actually kind of reject the notion of credit entirely, which is kind of crazy, I think, to me. But so there's this Bitcoin lender that exists called BlockFi. And you'd think that just facilitating lending activity, in a pretty standard way would be very uncontroversial. But that's not the case. In Bitcoin land, it's incredibly controversial. It's just the topic of a really heated discussion. But yeah, I think Bitcoin is similar to gold in that, it's relatively cumbersome to move, and it's treated as something that, is valuable. And then you can also use it additionally, unlike gold, as this high-powered and highly transparent and auditable collateral upon which you can build, any number of kind of financial applications.
So why do we need that? Why do you feel that we need a new financial system and one that is more constrained in its credit formation?
I mean, I think the current financial system in many ways is highly exclusionary. So that's one thing.
You're talking basically about the unbanked and all that stuff.
Yeah, but, I was on the train over, I was challenged with the same question. Doesn't our legacy or current financial system work just fine? And
was that a serious question?
Yeah, it was serious.
He really seriously asked, doesn't it work just fine?
And it always kind of, I'm always sort of astounded when people ask me, because it's like, how sheltered must you be,
That's so interesting.
to believe.
Did you ask what line of work this person was in?
They were an investment banker.
Oh, so, God.
Yeah, it's the Acela. So it's, it's like you
Did
can
he tell
always
you
do
what
networking
company,
on the
what
train.
company was he?
No. I'm not gonna dox this guy.
Oh man.
But it's interesting because if you spend time outside the U.S., you kind of know that there are many countries with high inflation. That's like a fact of life, and the local sovereign currency is not something that's appropriate to save in. You just wouldn't want to do it. And then B, even within the U.S., there's a lot of arbitrariness and caprice, especially as banks have become more risk averse recently. They're banking, they're excluding more and more classes of activity from acceptability within the financial sector, whether that's cannabis businesses, which are totally legal, or it's sex workers, or even basically the whole cryptocurrency community has become unbanked at some point because they're perceived to be too risky. So there is a huge amount of arbitrariness, I would say, within the current financial system, even within the US. And if you do something as silly as simple as putting Cuban restaurant in the memo field of your Venmo transaction, you risk getting yourself frozen out of that account too. And, the other category of thing is happening now is that banks are being pressured to use their services in a political way to, unbank the NRA or, gun manufacturers, which, regardless of your beliefs on that, is a worrying sign about how financial services are being weaponized to exclude whole classes of activity or to punish them. And, as we see the US use SWIFT as this enforcement arm, this policy instrument abroad, and they use the threat of sanctions, that I think delegitimizes the established financial regime that they created. They created this nuclear umbrella of like financial services that works globally, and now they're selectively withdrawing it. So I think it's a good time to be skeptical of the kind of dominant financial system.
Well, that also kind of opens the door to a few things, one of which is how realistic is it that you'd be able to build an alternative financial system when there's an existing oligopoly that has the support of the United States government and all governments worldwide. The central bank is an established institution that goes back many centuries. So that's one thing. We should probably get into it. But before we do that, listening to you talk, one of the things I was thinking about was what different people see in Bitcoin. Up until now, we were talking, when we were talking about these narratives, we were talking about what Bitcoin is. But it also seems to me that, and maybe there's some intersection here, but there is, for different people, Bitcoin represents something else. And I mean in a sense of aspirationally, right? For Austrian types, it represents an opportunity to bring back sound money, right? For other people, it represents an opportunity to be anonymous, right? And we kind of touched on both of those things, but how do you think about that, the way that people come into it? And of course, I think the predominant one is people want to get rich, right?
Yes, that's probably the main thing that people care about. But yeah, to some degree, it reflects your own expectations and desires. Because as you say, you have people that are Austrians and, they have this profoundly restorative objective. They want to go back to the 1890s, or at least the monetary system. And then you have people that have a altruistic motive. They see the potential of cryptocurrency to really bank the unbanked, so to speak, although that's become a bit of cliche in the industry. But that's still a very profound motive. I would say typically it involves helping out some marginalized population. But then you also have, libertarians and anarchists that have seized on it, and people that see it as a slow-burning rebellion. I mean, really, like a fuck you to the state, basically.
Oh yeah,
Sorry,
it's fine. I think Pierre falls in that category.
Yeah.
When I had Pierre on the program, it felt to me very much, and I think he admitted it, and he wouldn't deny that he's ideological, and I think a big part of the community feels that that's the way ultimately to be successful with this.
Yeah, it's been characterized as political, and I would say it is political. It's in part the really dogmatic corners of the industry. It's a reactionary movement rather than a progressive one.
So the question is, I guess, because then also you've got Wall Street, right, licking their chops, and they've gotten involved the last couple of years, which has definitely helped drive adoption. And again, adoption's important. One where, we may despise certain characters or people, but to the extent that they're able to drive adoption in a sustainable way, I think that's generally a good thing. Now, whether it's good to hype a price and have, giant booms and busts, I don't know, that's a different story. But how do these camps reconcile themselves, right? So you've got like these buttoned up Wall Street types that want to use this as a financial instrument, build derivatives to trade off it. And then you've got these political activists who see it as part of a larger ideological mission to take back power from the state, right? And then you've got just people that are technologists that like to tweak and solve problems. How do all those people come together? And this is kind of a way of asking also about the governance of Bitcoin.
Yeah, it's very funny and many people find it to be paradoxical in some way, because, having been inside of a large financial institution, one of the largest, that decided early on to be a service provider for Bitcoin.
Fidelity.
You wrestle with these paradoxes. And I think the truth is that there are more radicals within the Wall Street institutions, within the JPMs and the Fidelities and the Goldmans, than you might think.
Because they know how effed up their system is.
Well, it's just because once you get turned on to this notion of building for Bitcoin, it's kind of hard to get off it. And it really is.
Why is that?
Well, it's just because it's such a subversive idea,
What is subversive about it?
That the state should no longer have, the right to mint currency, that we can disempower them. And, the thing is that you can dare to dream because Bitcoin is this just colossal juggernaut that it seems very, very hard to interfere with.
So let me ask you something, because this touches on, I think, a very interesting thread, which is something that I talked about with Ben Hunt in one of our recent episodes. And I think it speaks to the disillusionment of society, certainly in the United States, with the government. I think there are two really important events that drove that home. One was the failed, disastrous occupation of Iraq and the lies that were incorporated in selling that war. Then you also, of course, had the invasion of Libya and a bunch of other things during the Obama administration, but you had also the 2008 crisis. It was those two, the Iraq war and then 2008, the 2008 crisis, which was a larceny of the federal government and the Treasury, right? How big of a role does that play in your view in all of this?
I would say absolutely critical. There's nothing more indicative of the largesse of a captured democracy than, and also there's nothing more indicative of the failures of a fiat regime than something like a war, which spends $1 trillion or multiple trillions of dollars, which can be summoned out of thin air. And, this is one of the best arguments in favor of a sound money, in my opinion, that if you wanted to go to war under the gold standard, for instance, you would have to actually tax your citizens and figure out how to pay for it, beforehand.
I would disagree with that. You could borrow the money.
Well, you can borrow the money.
And that's exactly what happens during wars.
And that's true. And actually, Saifedean makes this point in his book, The Bitcoin Standard, that a lot of the historical incidences where countries have left the gold standard has been precisely because they wanted to finance warfare. But the ease of doing it under kind of an inflationary regime, I think, is really startling. The ability to marshal those funds and then pass it on to future taxpayers.
Well, one of the things that, and I don't know if I have not read Saifedean's book, but many have read it in this community. One of the things that we do know historically, even in the United States, Civil War is a perfect example. Lincoln issued the greenback. So governments have shown a willingness and an ability, even under regimes of hard money, to issue fiat-denominated currency in order to finance wars. In other words, when it comes to existential crises or anything that the state deems to be sufficiently important, the state has shown an ability, a willingness and an ability to subvert a hard money standard, which kind of brings us to a question that I have in my mind, which is that, let's say the community of Bitcoiners manages to build this alternative system and it scales to some degree where it captures some percentage of global commerce. Why does that matter? The question is, ultimately, how does that prevent governments from doing what they want? This is a point I brought up to Pierre as well.
So this is where I think it departs from the comparison with the gold standard, because a gold standard is still ultimately administered by a government. A Bitcoin standard is administered by code and the kind of inner subjective consensus of the Bitcoiners and by cryptography. So the ability to intervene, to exercise monetary discretion is really radically reduced. And if this experiment in governance succeeds and you spread the decision-making power to a global audience, you're not going to be able to have, interest groups which are able to alter the rules of the chain in a way that's favorable to them.
Well, I want you to walk me through that, because I don't fully understand the difference between this and, let's say, the classical gold standard. What is that distinction in your view?
Well, I would say a gold standard is just more fragile because of the nature of gold, and in practice,
because of the auditing process.
Well, yeah, because gold concentrates itself because it's costly to verify it, and so it ends up in these centralized silos, basically.
Isn't that also the case with Bitcoin? Isn't there concentration within the network, both at the exchange level, but also in mining pools in terms of new issuance?
Yeah, there is. In practice, the supply tends to accumulate in exchanges, which is unfortunate, but
and that's also part of the
reality.
issue, though, with scaling on layers above the base layer, right?
Well, if Lightning was successful, for instance, you could have scaling without the trade-off of needing to pool liquidity or pool collateral into a large hub.
But even with Lightning, aren't there trade-offs that are made within the network that lead to centralization at different parts of that network? What I'm basically getting to is that we're not there yet, right? And in getting there, I question whether this system will look any different than our current financial system, other than an important distinction, which is the base layer, and not just the immutability factor, but the supply schedule. right? The deflationary supply schedule. That to me is the only clear distinction, which is an extremely important distinction. And to what extent it's a workable distinction, I'm not sure. But what would you say to that?
Yeah, I think just a hard money system where the supply really was inviolate and it progressed according to the preordained rules, that alone is a really significant improvement over what we have now. And to opt into that system and opt out to the legacy system, that alone is a very powerful and important thing. So to me, it's perfectly natural that we should have a non-state money, in complement to all the sovereign monies. Maybe some of them, the monetary authorities are going to find their sanity again and start to behave better. I think that ultimately could be the greatest contribution of Bitcoin to the world.
It's a check. It's a check on global power at the sovereign level.
Absolutely. Absolutely. So I'm not demanding that this system grows and scales to a global level and includes every individual on Earth and they're forced to buy Bitcoin. I think that would be silly. But I do think that if we're able to succeed in our objectives, we're building something which could be very useful to anyone on Earth if they so desired to engage with it. But the beauty really is that it's non-coercive, so that no one is forced to. So it's very much a social contract that you can actually, weigh and determine whether you want to opt into this thing or not. That's the beauty.
I believe you told me you read Homage to Catalonia.
Yeah, that's my favorite Orwell book.
Talk to me about the role of anarchism, both in the community, but also the philosophy of anarchism to you and the importance of this idea. I mean, you touched on an aspect of it, which is non-coercion. How important is that to you?
Well, I'm not an anarchist, so I don't have any of these.
Well, you're not a militant anarchist. But I mean, just the idea that there shouldn't be coercion, right? That takes, I think, from, and I don't mean that in any pejorative sense. I think we did an episode with Karn Ross, the diplomat. I think it was episode 10, where it dealt in part with anarchism. I think anarchism is an admirable philosophy. The question is it workable, right?
Well, I see Bitcoin as building this system of sort of independent property rights. I suppose you could characterize that as anarchist, but it's like building any other institution. It's just that this institution manifestly is outside the control of the state.
Right, but its governance is anarchic. Its governance is fascinating. And I'll say its governance is something that I didn't appreciate early on. And I think it's the aspect of Bitcoin that I least appreciated and that I've come to most admire and think offers not necessarily a template, but it should be studied by everyone. Everyone should look and see what's happening in this community and how people come to sort of intersubjective consensus about what Bitcoin is and should be.
I would say Bitcoin's governance is like looking at a flock of sparrows that are producing a murmuration where they're all flocking together in the same way. It's really breathtaking if you've ever seen it. Starlings, rather, not sparrows, sorry. And, each individual bird within the flock has agency, and yet they all act in concert together because that's, I actually don't know why they murmurate, but each bird just looks at its neighbors. There's a paper on
Murmurate
this.
means what?
When the flock is essentially pulsating, and it's like artistic almost in a way. I encourage you to watch a video.
Well, I think some of the similar, again, to shill our own episodes, we did an episode with complexity theorist Brian Arthur where we discussed some of the work in this area. And I think the same phenomenon is true of traffic patterns, for example. When you have independent automata in a system, their own unique decision-making creates these more beautiful patterns or complex patterns at the network level, so to speak.
So to elaborate on this, the interesting thing about Bitcoin governance is that there is no entity, really, which determines what policy is or what users in the network should do. The sovereign entity within Bitcoin is the full node. And if you want to participate in the network, you choose to run your node and you can set it to follow whatever, behavior or rules you'd like it to, but ultimately it's in your benefit to have it follow, the default set. However, this changes, there are frequently updates, and it's often the node operators that are the ones kind of forcing through the updates, as opposed to any elite cabal of developers which are handing down.
And those are distinct from the miners.
Yeah, so there are really three big interest groups in Bitcoin: the node operators, the miners, and the developers. And if you read probably the pre-2017 takes on Bitcoin governance from academia, you'd often read things like, well, actually, it's just a handful of developers that control the system. Oh, actually, it's mostly the miners, which are mostly in China, that control the system. Empirically, this just isn't the case. And the events of 2017 kind of showed us that. What was tantamount to a user rebellion against miners who were being intransigent was not pushing through the segregated witness upgrade. And so the users essentially overruled.
By users, you mean node operators?
Node operators, yeah. So they, through this policy of brinksmanship, they virtually overruled the miners, or sort of, it was a bargaining chip, essentially.
In the early days, were nodes synonymous with miners?
Yes, they were, yeah. And that was how Satoshi wrote about them.
Right.
And then
that's also another interesting point, though, right? Because that also speaks to differing visions of Bitcoin. There are people that think, I imagine today, I'm getting way out of my league, but I imagine there are people today who still believe that node operators and miners should be one. In other words, that anyone should be able to run a mining rig.
Well, I mean, in practice, unless you have an ASIC, your mining activity is going to be virtually
And even
worthless.
then, you probably need to pool with other miners in order to make it worth your while.
There is a faction within Bitcoin that believes that only miners are the relevant entities, because in the past they've been tasked primarily with resolving governance questions. But I don't think that's the case today. Mining is mostly an industrial kind of a utility, and the miners are not considered to be the essential political unit.
So I kind of took us off a little bit. You were talking about how in 2017, what we saw was actually that the node operators exercised a level of power over deciding what Bitcoin would or would not be.
Yeah, so there were really two critical events in 2017. So one was the so-called user-activated soft fork, which was a case where the miners had been tasked with rubber stamping this upgrade called segregated witness, and they were not doing it. You needed 90% of the mining power or 95% to ratify it, and there was only 40%. And then the Bitcoin community collectively came together and said, well, if you don't do this, we're actually going to partition the network.
How did that 95% come about?
That was kind of an arbitrary threshold that the developers used to set to incorporate so-called soft forks.
So it become
changes.
conventional.
Yes, to make sure that
it's just another fascinating point, though, right? That there's this convention of 95% that you're pointing to, which has an origin story that wasn't, it's not really clear, right? It just kind of emerged somewhere down the line.
Yeah,
because again, there is no foundational governance structure. There's no constitution.
Well, you could say the white paper is a very rough
the founding
constitution,
the canon, basically.
It's very open to interpretation,
right.
And Bitcoin's governance has developed in its own way over the 10 years.
Would it be something? I mean, like the white paper? Would that be something similar to, let's say, if the Bill of Rights was a document that some revered early American had put together, and it was something that, let's say, judges referred to, but it wasn't the law that they had to refer to it?
So the white paper is, in Bitcoin's context, it's a little bit like a brochure for the system. So Satoshi himself said this: the code itself is the system, and then the white paper is kind of an explanation of how it works. But the white paper is not exhaustive. It's extremely short. It's like 9 pages. And most of it is spent on this question of the security model. And, you could be critical of Satoshi. You could say, why didn't you fully specify the system? And his answer was that the code itself. So the rules expressed in the code was the system. So for instance, Satoshi doesn't say there's only ever going to be 21 million units of Bitcoin, but that is evident by looking at the first Satoshi client, looking at the code. So it's kind of an underspecified constitution. So maybe it's like a Declaration of Independence or a Federalist Papers.
Did he give an explanation for why it was set at 21?
I don't believe so, but the actual number itself is totally arbitrary as long as it's sufficiently divisible, which it is.
Or that it was deflationary. Was there an explanation for why it was deflationary?
I don't believe so, but if you think about it, I think that's the only way to create a system that would be mutually acceptable to people. Because if there was some built-in, inflation rate, so to speak, the question is, where do you set that, and who do you give control of the inflation rate to? And then you just end up back with the same questions that plague us today with the Federal Reserve. So I think the only way he could have created this system such that people would actually want to use it was to make the supply scarce and fixed, after an initial period of issuance. And if you think about it, if he'd created an inflationary system, probably what would have happened would have been people would have forked it to create a scarce version. And my guess is that one would have
Do
succeeded.
you think so? Because, I mean, there's a difference between arbitrary inflation or, let's say, a systemic type of inflation.
Yes,
Let's say
that's
2%
true.
every year or 1% or, it's not.
Yeah, and maybe a version of Bitcoin which had 2% inflation, so to speak. Although I think supply inflation as opposed to purchasing power inflation. 2% issuance every year may well be, and I think it probably would be, an improvement over the current system where inflation is totally at the discretion of a few individuals.
I think the bigger issue with the current system is that it's unaccountable.
I guess there's some political accountability, right?
Right, but clearly there's not, right? Because I understand what you're saying, but like just to bring it back to the outrage and the disillusionment, what we saw in 2008 showed us that at the limit, all bets are off. At the limit, what matters is saving the constituents that hold power in the system, right?
Yeah.
At all costs.
Yeah, so the problem, in my opinion, the really essential problem is that there is, the spoils of inflation are unevenly distributed, so it's people that own financial assets that have really benefited.
But also
in
the
last 10
power
years.
to change the code is concentrated.
Yes, and that means that there's a massive incentive to, join the rentier class and use your advantage, the access to the code, so to speak, to benefit yourself.
Right, and the incentives to change the code are also misaligned in that sense. Not the code, I mean in the case of the federal government, in the case of the Federal Reserve.
Yes. So the fact that there is no one who can privilege themselves by arbitrarily changing the rules of Bitcoin, that's the important thing, in my opinion. And the fact that, I do think it would be an okay system if there was a fixed level of issuance too. I don't think there's anything that special about 21 million units, but that was what we settled on originally, so that's what it is always going to be.
So we've spent a little bit of time now talking about the meta layer of this. Let's get into some of the more substantive parts of the discussion, because you've written quite a bit on how to value this asset, how to think about it. One of the more interesting contributions that I found had to do with market cap, realized market cap versus market cap as we think about it, and also thermal cap and economic density and throughput, another thing, which is, so actually I'll separate those two, the market cap issue and then also throughput. Oftentimes folks like myself, for example, will compare Bitcoin's throughput to transaction throughput for Visa, right? But you make this great point of differentiating between types of throughput, right? Economic throughput, as you call it. Let's begin though with market cap. How should we think about the value of this network?
Yeah, so the default way to think about it is by borrowing the concept of market cap from equities, which is kind of funny because I think it's probably closer to a commodity, and you don't really think commodities in terms of the market cap. I mean, if I asked you, you probably wouldn't know what the supply of gold is off the top of your head. But since it's so easy to quantify these things, this is what we ended up with. You take the supply and you multiply it by the current market price, and then you say, well, that is the economic significance of this thing. In Bitcoin, it's a kind of a silly way to do it because 15 to 20% of the supply is truly inert and considered lost.
Explain that.
Really deeply lost. So, Satoshi is believed to have about 1 million or so, 1.1 million maybe. There's some disagreement on this point.
Why is there disagreement? Because they can't decide who owns the wallets?
Yeah, because there's a couple million wallets just sitting there from 2009, 2010, which haven't moved, and some fraction of them is presumed to be Satoshi. But Satoshi didn't, sign them by saying, I am Satoshi. He just mined like any other network participant. So nobody really knows how many are in there. But just the fact that none of these coins have moved in 10 years, not to be presumptuous, but to me that signals that they're unlikely to ever move, actually. And for sure, we know that some of those coins truly are lost. Like there's a lot of stories of early Bitcoin miners that threw away their hard drives and it's in a landfill in Wales somewhere. So to me, it's a little arbitrary to use the total supply ever issued of Bitcoin as a proxy for its economic significance. So I devised this concept of realized cap where you take the every single unit of Bitcoin and you cumulatively aggregate the value of those units according to the price at which each unit last moved.
The last time it was marked to market.
Yes, because you can sort of naively assume that if there was a transaction between you and me, that's most likely settled on chain or recognized on chain. So I call this realized cap. And if you do that, so the market cap of Bitcoin today is around 200 billion, if I'm not wrong. The realized cap is much lower. It's about 95 billion. And you might say that that is roughly the sort of economic significance of the coins owned by holders in circulation that have actually transacted with it fairly recently. So, by that calculus, Bitcoin is actually less significant economically than you might have thought.
So I have a question about that, a clarification. In your paper, you cited a $10 billion number as the inflow.
Oh, that is a different...
that's a different thing entirely.
Yeah, that's cumulative security spend or thermocap.
Okay, so the realized cap, basically marking to market the last time these Bitcoins were moved, you estimated at 95, and the total market cap at the time of writing the paper was, these numbers have changed.
A lot, yeah.
But
since I wrote this.
when did you write this paper?
In September 2018. So
Okay.
the numbers are really different today.
All right, okay. So, but at the time there was a discrepancy of 20 billion, 95 to 115.
Yeah, today the discrepancy is much greater.
Right, and you were saying that actually meant that the Bitcoin network was worth less than people believe. I actually took it the opposite. And in fact, I also, not only did I invert that relationship, but I actually also didn't feel that same type of relationship held across different coins. So in the case of, for example, like an obscure coin, like not Bitcoin Cash, give me something more obscure. Something where no one gives a shit. Like they got the
Vert coin, maybe?
Yeah, whatever. Something
no
where...
disrespect to my Vert coin.
Right, I don't know, but something where, let's say, particularly if it was a fork, right? And they got these airdrop of this alternative coin, and they never really gave a shit about it. They probably lost the coins, you know what I mean? It reflects actually the fact that no one gives a shit about it, and it's really actually worth nothing. Whereas in the case of Bitcoin, couldn't you make the argument that the network is actually worth more on account of the supply? There's actually less supply?
I suppose you could. This is why it's such a beautiful measure. It's
because
open
market cap itself,
interpretation.
it's not exactly, because the market cap, it's not a stock, right?
Well, yeah. So, but this is really the
Brings
point
us back
that
to
I'm
the point
making
about the
is-
fact that you
is
don't think
that-
about gold's market cap.
Yeah, and really within the context of crypto, there's this immense perversity where these things they are like highly gamified, and there's all these like leaderboards like CoinMarketCap where the market caps of these various cryptocurrencies are compared. So my point was a rebellion or reaction to that, where as Matt Levine says, we're reinventing finance from scratch. This is a case where we probably overshot by making market cap the default measure. And I propose realized cap as a potential alternative, but maybe not, the best alternative. Who knows what the real answer is? But I do think that you might as well just look at the ledger itself to determine what the active supply is, what the float is. And the nice thing about cryptocurrencies is you absolutely can do that. So if 90% of the Bitcoins were lost, you'd want to know that, for instance.
Also, would you agree that one of the problems is that absent utility, it's really very difficult to measure the value of what is effectively a speculative asset that has only been around for 10 years?
Yeah, I don't think there's a way to value it, so to speak. Aswath Damodaran says they can only be priced, not valued.
Right.
Cryptocurrencies, that is.
Right. But I think, though, and I think that generally is true, and I've been very critical of this lack of utility with Bitcoin, but I think one area where that's not true has to do with the fact that real wealth is actually moved on the Bitcoin network. And I think this brings us to this distinction that you draw between throughput and economic throughput, right? Talk to me a little bit about that.
So yeah, the interesting thing about Bitcoin is that it tries to be as parsimonious as possible with the actual data overhead, because every node has to save the history forever. So that's where a lot of the disputes came in over how much data should be throughputing through the ledger every single day. And today, it's about 150, maybe 200 megabytes a day is transiting, or new information is being added to the ledger. So it's not a lot, really. I mean, you can store the whole history of Bitcoin on a regular commercial hard drive. So the way the Bitcoin operates, or the way it kind of should work, in my opinion, is that you attach a lot of financial value or economic value to each smallest byte. So every day, Bitcoin will do a few $1 billion of transactional volume, which is kind of remarkable that it's compressed into so few bytes. Because the externality here is that the node operators incur the cost of ingesting all that information and saving it, and they have to spend money on bandwidth. And the Bitcoin developers have always tried to be super, parsimonious and stingy with the data flowing through the system. So it should be disentangled. The data overhead and the number of read-write operations, number of transactions per second, so to speak, which is fairly low. It's about 7 at the maximum. And the actual economic throughput that's flowing through the system, which is really, really big. So if you can move that lever of making your average transaction pretty large, you can achieve, a really significant economic system, even if you have a low data
Actually,
overhead.
let's parse this two things, because I think you're touching on two separate ideas. One is that, generally speaking, each transaction on the Bitcoin network has more economic value than, let's say, each Visa transaction.
I would say absolutely, yeah.
Right. There's data that backs this up.
Yeah, your average Bitcoin transactions can be in the thousands of dollars, typically.
So first of all, and that also has to do with the fact that it costs more to transact on Bitcoin than it does to transact with your credit card.
Absolutely.
Right?
Yeah.
So there's that aspect of it. But then there's also this other aspect which you're touching on, which has to do with efficient use of the base layer. Right? And a lot of that deals with exchanges and batching.
Yeah, so it's rather neat, I think, that Bitcoin transactions are actually costly and that Bitcoin block space is a scarce and costly resource, because that induces among market participants like exchanges, good behavior. So to have a light impact. So batching, where you combine a lot of transactions together to minimize the fixed cost of data involved in each transaction. That's one way that exchanges are encouraged to have a light impact. But it's not just us encouraging them to do it. They're actually economically incentivized to do it because they save on fees.
How much more efficient do you think core developers can get with the base layer?
We're actually probably reaching the limits of efficiency. I would say your typical Bitcoin transaction is 250 to 300 bytes, and that has to be stored by virtually every node forever. And there are some cryptographic enhancements, like using a different kind of signatures, so using Schnorr signatures instead of the one that we have now, that might give you more efficiency, and in particular in terms of multi-signature transactions. But yeah, we're kind of getting there, because there is a lower bound to, because the transaction has to contain a certain amount of data to work. The problem is not with the core developers, I would say, but with the exchanges, who have historically been really profligate in their usage of block space, because they could socialize a lot of those costs to their end users, just pass the costs along, the fee costs. Also, merchant payment systems like BitPay, for instance. BitPay they had a habit of passing on the fee costs to their users. So their incentive was not to do cost-saving transaction constructions, which is a little bit perverse. So I think the only way this is really resolved is if fees actually continue to climb, thus making block space more valuable and kind of inducing the big industrial operators on the network to, behave better in terms of making small transactions.
Where are we? I mean, this is not in my notes, and you haven't really seen you write about it, so I'm not sure what your fluency is on it, but where are we today? Where are developers today in scaling beyond the base layer? If we're getting to the limits of efficiency on the base layer, where is the community besides that?
Well, the main scaling vector that people have settled on is Lightning, which is a way to defer settlement from payments and then eventually settle them onto Bitcoin, but you win a lot of scalability. It does have an interesting model where you have to kind of, lock up collateral and have some liquidity present on the so-called Lightning network for it to work. And like any other network, it needs to grow before it's useful. There's still a relatively small amount of Bitcoin on there. But that has been the main focus, I would say, for the last few years.
If, hypothetically speaking, if the entire current financial system were willing to adopt Bitcoin as a base layer for settlements, what would be the difference between that and, let's say, what is emerging through the Lightning network and whatever will be built in second layer solutions?
Well, I think in 10 years, we might look back and be like, remember Lightning? Like, that was a weird thing. And there would be some totally alternative overlay network on top of Bitcoin, which works just fine. So I don't think Bitcoin's future is really indexed to the fate of Lightning at all. I still believe it's going to be successful, but
Tell me about that. Explain to me why you feel that it's going to be successful.
Well, just the caliber of individuals that I know that are working on it. Really, really talented people. And there's a lot of critical mass there, and startups as well that are building on top of Lightning. So I think that it will be useful. However, the nice thing about these overlay networks is that they are not critical for Bitcoin to keep working as intended. They can fail, and Bitcoin still does its thing, because ultimately Lightning is a special kind of time-locked multi-sig transaction on Bitcoin.
What do we know about security at some of these exchanges?
Typically very weak, I would say, and they're infamous honeypots for attackers.
How often do they get attacked?
All the time. Billions of dollars have been stolen from exchanges. And I think the reason that it's so bad is because you had really amateurish people building exchanges for a long time.
By the way, that's another huge vulnerability for systems using proof-of-stake implementations at exchanges.
If an exchange is hacked and then a lot of stake goes to the attacker. Yeah, so that's why I think a lot of people believe that the Ethereum Foundation chose to roll back the so-called DAO attack. The DAO being this pool of capital on Ethereum in the early days that got exploited, and it was a really big pool of capital. It was exploited, and the Ethereum community, or more specifically the Ethereum leadership at the time, decided to move to a new state of the chain where it was like that exploit never happened, right? And they had stated their desire to move to proof of stake. They're still planning to do that. And the kind of conspiracy, or maybe not conspiracy, but like one of the explanations for why they marshaled support to make this very arbitrary change to the state of the ledger was because it meant that in a future proof of stake world, the person who'd hacked that DAO would have a huge amount of political influence in the protocol later on. And so they were trying to strip them of their future influence. They didn't want a black hat to be influential. So yeah, but that is definitely a critique of proof of stake. I would say that if you can acquire coins costlessly or cheaply, you can acquire influence cheaply.
Well, I think this is a problem, though, this thing of exchanges, right? Because, again, we've covered this on the program with Bruce Schneier, most notably, but also with Josh Corman, generally speaking around the vulnerabilities of servers to being attacked, cyber attacks. These are getting easier and easier to conduct, and the level of sophistication required by the attackers is going down. I'm not sure how people can expect exchanges to be a secure place to leave their keys in the future.
Yeah, and exchanges are just, in practice, what they are is colossal kind of bug bounties, because you get to claim your reward in something that's financially valuable, which wasn't really the case before with like other exploits, right? So the creation of cryptocurrency, made the world this amazing, like, lucrative bounty for hackers where it wasn't before.
So here's a legit real world problem, right? The fact that we're moving into a world where it's going to become increasingly more difficult to secure your database, right? And this is ultimately why the base layer is so valuable, right? Because you can secure your wealth on the base layer. But how do we navigate this, right? And this isn't just true for Bitcoin. It's true for everything.
Yeah. I would say...
How does the community think about this problem?
I believe that the cryptocurrency community has a really significant incentive to work on these security problems. So that's why we have all this innovation in hardware wallets, and also innovation in custodial setups, which is a lot of what our fund looks at. So before, strings of information were not worth billions of dollars, and now they are. So the world has had to learn, how do we safeguard 128 character string of information in a way that's truly, truly secure from keyman risk, from hackers, from other exploits. And so you have custodians doing really interesting things there. So the consequences of failure mean that the cryptocurrency industry is spending a huge amount of effort working on this problem, which most likely will spill over into other disciplines, and I think it'll be useful in terms of security. So to some degree, like, the crypto industry is this like testing ground for security. And because the stakes are so high over here, interesting lessons are learned in crypto land, which then are just, they become general InfoSec lessons.
How do you think about attack vectors in Bitcoin?
Yeah, it's a tough one because my guess is that whatever attack is best against Bitcoin is not one that we're anticipating. The most commonly cited ones are probably quantum computing, miner collusion, or just governments actually just shutting down mining. I tend to believe that it's much harder than most people think to shut down mining.
Well, let's talk about the miner collusion, because there's also a disincentive for a commercial entity to attack the network, right?
If they're a miner, yeah. And if they own Bitcoin ASICs.
Right. Okay, but my point is, if you're going to, let's say you're a commercial entity and you want to monetize your reward, how would you go about doing that today?
If you had successfully attacked Bitcoin?
Yeah.
Well, I mean, you would, sell it on an exchange.
Before anyone would know what was going on.
Yeah, so that's the challenge. In practice, monetizing 51% attacks in crypto land is very hard because the exchanges are all kind of tuned on to them. And so if they see that there's an attack occurring on some coin, they'll just stop deposits.
How quickly does the community pick up on that? From the moment an attack begins to when generally everyone knows.
It's not a formalized thing yet, I would say, but exchanges are very attuned to this. But there's still a lot of confusion, I would say, when these attacks actually happen. Like, there's actually an attack happening on a minor cryptocurrency called Verge today, where its proof of work function is being exploited. So they're fairly common.
Right, on smaller ones.
Yes.
But how valuable is that to exploit?
Not very valuable for Verge, yeah. And
you're basically stealing from I guess you're taking the money from the exchange.
In that case, they're actually accelerating the inflation. So they're stealing kind of from the protocol, so to speak. But yeah, the typical 51% attacks involve attacking exchanges. You make a deposit, and then you introduce an alternative state of the chain where the deposit never occurred. But meanwhile, you've withdrawn another cryptocurrency.
I think also something else that comes to me when you're talking is separate from the technical challenges of, let's say, scaling an alternative financial system. There are also the behavioral challenges, the behavioral changes that would be required, right? People are used, for example, to thinking that if their money gets stolen at Chase Bank, it's not their money. There's like that scene that Robert De Niro in Heat. Have you seen the movie Heat? They're robbing the bank. He's telling everybody not to be a hero. He's like, it's not your money. Your money's insured by the federal government. You're not going to lose a dime. But people are used to insurance, right? At least with the original visions of Bitcoin, the idea would not be to rely on insurance, but to rely on self-sovereignty and responsible custodians and savers, right?
And I think if you added insurance into the mix today, if you had FDIC insurance for Bitcoin accounts, for instance, on exchanges, I think that'd be really, really dangerous.
Of course, because FDIC, you mean government insurance?
Yeah.
Well, that kind of wouldn't work.
No, but in the preposterous thought experiment case, I think it would be catastrophic because then everybody would keep their coins on the exchange, and then you'd be liable to a bug or an exploitation or confiscation. So,
but to be clear, though, in such a situation, it would imply that the base money is not Bitcoin, but it's actually the issuer is the FDIC insurance. But even in a case of a private issuer of insurance, that would just, no matter what, you're going to have financial crises in this type of a system. Nick, I want you to stick around for our overtime. I want to get into energy because you've done a lot of really interesting work there in terms of the energy costs associated with proof of work, where that energy is coming from, and some of the opportunities, some of the economic externalities there. And I also want to talk a little bit more about open source development, fork diplomacy, and maybe get into some philosophy stuff too.
Okay, I'm here for it.
Well, it was great having you on. For our regular listeners, you know the drill. People that are new to the show, head over to patreon.com/Hidden Forces, where you can access this week's overtime, as well as a transcript to my conversation with Nick, as well as this week's rundown, which is much better and more coherent than my thoughts have been during this conversation. Nick, I appreciate having you on.
My pleasure. Thanks for having me.
Today's episode of Hidden Forces was recorded at Creative Media Design Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links, and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.